Hello, all the CMA intermediate students who are preparing for June 23 and December 2023 attempt under 2016 syllabus. Now, this video is really important for all the students who are preparing for Group 2 specifically, that is paper number 10 who are preparing for. This video is really important for you guys. Please listen to the video for the next 2 to 3 minutes. This lecture is a part of our paid series, that is CMA paper number 10 module question discussion series. But this particular lecture will be available on the YouTube. That is why I'm giving a message to the larger audience. I just wanted to give the message to the larger audience. That is why I have decided to put this particular lecture on the YouTube also. Okay, so what is the message, sir? What is important? See, as a professional, tomorrow you are going to be a professional. It is very important that you learn the right things. Why I'm saying all these things, sir? I was going through this module. I was going through this paper number module. Specifically, the second part, sir. Specifically, the second part of financial management. I often get a lot of queries regarding this. That, sir, this is the problem. Sir, this is the problem. Sir, we are finding it really difficult. The financial management part of paper number 10. The cost accounting part we have already covered in our paid course. That is already covered. Now we are going to start with the financial management part. And what I observed was that, sir, some of the techniques used, some of the questions, solutions, the way they have been presented, that is not really up to the mark. You people need to learn the right way, right? And all those who really want themselves to groom into good professionals, into the right professionals, they must learn it the right way, right? And for that, I request all of you, you can join our CMA paper number 10 module series from our website. The links are given in the description of our video. And very affordable course, sir. Only 2360, 2360 rupees, in which we are covering the whole module of paper number 10 and will make it easy for you. The most importantly, more than easy, will make it right for you. That what is right for you to understand, that is really important, because we want you to be the best of professionals in your field. That is really important, right? So this was a message from my side. All those who want to join, sir, they can go to our website. The prices are already very affordable. Please do not ask for any other discounts, right? We have kept it already at the minimal prices, very minimal prices, right? And I know many of you after this video will be asking for, sir, the remaining part of CMA, what about the remaining part? Learning curve, transfer pricing, I have covered in this course. Learning curve is covered, transfer pricing is covered, right? Because I wanted to cover on YouTube, but I was little disappointed with the CMA students, the way they approached the subject, the way they approached, I can say their approach was to the investment in their future, investment in the very affordable courses that we are providing, right? That was really poor, really poor. So I've decided to keep it on hold till the time I feel that the students are really connected. I'll not put that. Okay, so because I wanted to give additional benefit to those who have really invested in this. Yes, they deserve that additional benefit. And if you want that additional benefit, the query supports and everything, the details of everything, then you must invest in your future. Okay, so as decided in the batch, sir, we are going to start with the financial management part. The cost accounting part is complete. In the financial management part, we are going to start with the ratio analysis. That is study note number 7. Study note number 6 is absolute theory that you can go through. If you feel any queries, you can ask me, right? For the paid batch students. Okay. After that, as I told you, the fund flow and cash flow will do these two particular topics in the end, right? Because these are lengthier topics, a lot of adjustments and all those things. So we'll keep it for the end. First, we'll do the ratio analysis. Then we'll move on to the working capital part, right? So we'll cover that. We'll quickly cover that. Don't worry about it. Okay. So financial ratio analysis, we have done all the concepts and everything on the YouTube. That is available, sir. Right. And this course is available in English and Hindi for all those who don't know it. This course is available in Hindi as well as English. You can join any as per your wish. Paper number 8 is also available. Paper number 10 is also available. Okay, let's start with illustration number 1. So total 10 illustrations we have. We'll try to cover 4 or 5 illustrations in this part. because we are keeping it to 30 minutes a lecture, and the rest of the part we'll be covering in the next video. The following is the profit and loss account and the balance sheet of the PKG Limited. Redraft them for the purpose of analysis and calculate the following ratios: gross profit ratio, overall profitability ratio, current ratio, debt equity ratio, stock turnover ratio, finished goods turnover ratio, and then liquidity ratio. Right, sir. The profit and loss account is given. Sales are given. Closing stock of raw material, closing stock of finished goods, profit on the sale of shares, opening stock of finished goods, opening stock of raw material, direct wages, manufacturing expenses, administration, selling and distribution, loss on sale of plant, interest on debentures, and net profit. Now, what is the first line that he is asking for? He says, redraft them for the purpose of analysis. That means before calculating the ratios, you have to redraft this profit and loss in a way that it is easy for the analysis, right? In this way, now he's asking for the GP ratio. How can you calculate GP, sir? Everything is mixed. The GP is not calculated separately. Then how can you find out the GP ratio? Not possible, right? So you have to redraft in such a way that you are able to calculate, you are able to do the analysis, which is easy for the analysis, as well as you are able to calculate these ratios. Clear? Okay, similarly, the balance sheet is given to you. So balance sheet is simple, sir. Balance sheet no need to redraft as such, right? Okay, so for the first thing is they have redrafted the income statement. That is absolutely fine. That is sales is given to you. Cost of goods sold. What is there in the cost of goods sold? So raw material consumed. What is the raw material consumption? That is opening stock of raw material plus the purchases minus the closing stock. 50 plus 3 lakh minus 1 lakh 50,000. 50,000 plus 3 lakh minus 1 lakh 50,000. This will give you the raw material consumption. Then wages are there. Then manufacturing expenses are there. That is the cost of production. And the adjustment of the opening and closing stock will give you the cost of goods sold. Right? The cost of goods sold. Now, from the sales, if you remove the cost of goods sold, what you are getting is the GP. That is the gross profit. That is all the direct expenses we have adjusted as plus the adjustment of both the stocks, that is the raw material stock and the finished goods stock, that will give you the GP. Now, after GP, you will remove other operating expenses, administration, selling and distribution expenses are there. You will get the operating profit. From the operating profit, you add the non-operating income, that is the profit on the sale of shares and the loss on the sale of plant, right? So all these things are given to you. Clear? This was direct, this was direct, this is indirect operating, this is operating, this is non-operating, interest on debentures, this is after the EBIT. So from here, EBIT minus the interest on debentures, you will get the EBT, that is net profit before taxes. After that, you will pay the taxes and you will get EAT, that is earnings after taxes, right? After that, he has prepared the position statement. Position statement is basically the balance sheet. That bank is given, debtors are given, liquid assets you will get from here. If in the liquid assets you add inventory, you will get current assets. So you can prepare as per the requirement. Even if you will not prepare, you can calculate all these things from the balance sheet directly also, right? But yes, profit and loss statement redrafting was important because for the calculation of GP and other things. Otherwise, the ratios would have been difficult to calculate. Right, sir? So this is the position that they have provided, that what is the current assets minus the current liabilities, working capital, current assets minus current liabilities, you will get the working capital. Add fixed assets, capital employed in the business minus the external liabilities, shareholders funds minus preference share capital, you will get the equity shareholder capital. Now this external liability is what? This is your long-term debt basically, right? This is, he's talking about long-term debt. Shareholders fund, this is also known as only equity, or this is also known as net worth, right? Net worth. So minus preference share capital, you will get the equity share capital of 2 lakh rupees. So this is how the position statement of the balance sheet has been redrafted, showing the various important elements, that what is the liquid assets, what is the current asset, what is the fixed asset, what is the working capital for the calculation purposes. Now he's asking you to calculate simply, sir. The first thing is asking you to calculate the GP ratio. It can be calculated. Yes, sir. Gross profit divided by sales into 100, right? So gross profit is there, sales is there, gross profit by sales into 100. You will get the GP ratio. right? Gross profit ratio, gross profit by sales into 100, 50%. Okay, he says this equity share capital is divided into two parts. One is the share capital part, right? Another part is the reserves and surplus. It is one and the same thing. If the reserves and surplus are given in the question, I don't know whether, yes, 1 lakh is given and 1 lakh is given. This combined is known as equity share capital, right? This is 1 lakh is share capital and 1 lakh is reserves and surplus. Clear, sir? Any doubts about this thing? Right? So this was this. Now, the second is asking to calculate the overall profitability. Overall profitability can be calculated in two ways here. Here they have calculated it with the operating profit. That operating profit divided by capital employed. That as per the capital employed, what is the operating profit? But if you look at the overall profitability ratio, that is the net profit to sales ratio, right? They have calculated it this way, that by employing this much capital here means the debt also, the preference share capital also, and each type of capital. Basically, the capital here means this part. If you talk about the capital, if you want to talk about the capital, sir, what is capital? What is capital employed? This whole part is what? This whole part is your capital employed, right? This whole part is your capital employed. So he says by employing this much capital of 5 lakh rupees, what is the operational profit that you are earning? That shows the overall profitability, or you can calculate it as net profit divided by sales into 100. That is also your overall profitability, right? Net profit is 3,85,000 and sales is 10 lakh, right? That is 3,85,000 divided by 10 lakh multiplied by 100, right? So this is also the overall profitability that it shows, right? Because this is not absolutely clear, sir. Overall profitability, if you look at that, what is the net profit that you are earning? Sir, if 50% is the GP, how can the overall profitability be 80%? Clear? So this is a little bit of a dicey matter. That is why I said that this module is really ambiguous, really. Okay, after that, he's asking you to calculate current ratio, right, sir? Then he is asking you to calculate current ratio. Current ratio is simple, sir. Current assets divided by current liabilities, right? What is the value of current assets? That is 4 lakh. And the current liabilities is 1,50,000. So current assets divided by current liabilities, no issues. Next part, be very careful. He says the debt equity ratio. Now, when you are talking about debt equity, he says long-term debt. Fine, sir. Divided by long-term funds, 5 lakh, 2 lakh divided by 5 lakh. Sir, how can you take all the funds in the debt equity? Sir, you are talking about debt divided by equity, right? You are talking about debt equity ratio. You are talking about debt divided by equity. Then how can you take the value of the debt? This 5 lakh includes this 2 lakh rupees. This 5 lakh includes 2 lakh rupees of debt. How the debt is included in the equity? That is absolutely out of mind, sir. How can you do it? Sir, how can the debt equity ratio be? This what they have calculated is basically only the debt ratio that shows that out of the total capital employed, how much is my debt? But you are talking about the ratio of debt to equity, right? So this is absolutely wrong, sir. This is absolutely horrible. How can you do it, sir? This is logically wrong. It should be 3 lakh. This is how it should be calculated, sir. Right? How much? 2 lakh divided by 3 lakh is equal to 0.67. Clear? Arey, sir. 1 second. Clear? 0.67. This is how, and they have done this particular blunder in many questions, not only in this question. Now, after that, stock turnover ratio is raw material consumed divided by average stock of raw material. Opening and closing stock of raw material is available, and raw material consumption you have calculated. So simple, sir. Right? Finished goods turnover, COGS, that is cost of goods sold divided by average stock of finished goods. Opening and closing stock of finished goods is given. COGS you have calculated, right? So that is done. Liquidity ratio is liquid assets divided by liquid liabilities. Liquid liabilities is current liability only because bank overdraft and all that thing is not given. So liquid asset is what? Liquid asset is current assets minus inventory. Current assets minus inventory. So liquid asset is current assets minus inventories minus prepaid expenses. Yes, if there are any prepaid expenses, are there any, sir? Prepaid expenses are there? We need to look at. Sir, where are the prepaid expenses? Because he has subtracted 1 lakh as prepaid expenses, sir. I don't know if there are any prepaid expenses in this. Why? 1 second, guys. Current asset 4 lakh rupees. I don't know for what they have subtracted 1 lakh as prepaid expenses. Okay, actually what they have done is, see, again the presentation problems are to confuse it. This 1 lakh is not prepaid expenses. This is a part of inventories only. Inventory of raw material and inventory of finished goods. So there are no prepaid expenses, minus 0. Sir, at least do the presentation right so that the students don't get confused. You have not given prepaid expenses in the question and you are directly writing minus, minus, minus. What is this, sir? Very poor presentation, I would say, specifically in this case. Right, I'm not really satisfied with the financial management part of this module. That is why I have given this message at the beginning of the video. So liquid liability is current liability here. No bank overdraft or cash credit is given. So 1,50,000, you can calculate the liquid ratio. Right, so mark it as an important question. Yes, definitely this is an important question. Plus be very careful with the debt equity ratio. They have done blunders with the debt equity ratio. I don't know who is making this module, sir. I don't know who is making this module, seriously. Okay, let's move on to the illustration number 2 part. A company has a profit margin of 20% and the asset turnover of 3 times. What is the company's return on the investment? Okay, return on investment means whatever the investment that you have done in the assets, what is the return? What is the profit that you are earning on that? How will this return on investment vary if the profit margin is increased by 5%, asset turnover is decreased by 2 times, and the profit margin is decreased by 5 times and the asset turnover is increased to 4 times, right? So there is no absolute figures which are given here. How to find out, sir? How to find out? There are no absolute figures that are given, but what is given is a profit margin of 20% and the asset turnover of 3 times. Now the profit margin is calculated on what? The profit margin is calculated on sales, right? So what is given, sir? Profit margin of 20%. Let's see. I'll explain here. You are given 2 things basically. One, he says the profit margin is equal to 20%. That means, what does it mean, sir? It means that the profit is equal to 20% of sales, isn't it? The second thing that is given is the asset turnover ratio. Asset turnover ratio. That is given as 3. Now, what is asset turnover ratio, sir? That by employing the assets, what is the turnover that you are generating? That is sales divided by assets, right? That is given as equal to 3, isn't it? Now I say let sales be 100 rupees. Let sales be 100 rupees. Now, what is the profit, sir? What is the profit? Profit is 20% of 100. That is 20 rupees. Now, can you tell me what is your assets? What will be your assets from this asset turnover ratio? If you want to calculate the assets, what will be the assets, sir? What will be your assets? Now he says the assets turnover ratio. Okay, 1 second. One second. Not this way, sir. This will come in the points actually. I'll change the situation here. Wait. I say let total assets be 100. Let total assets be rupees 100. Right? So what will be the sales here? What will be the sales here? Sales here will be 3 into 100, 300. Any doubt? So what will be the profit, sir? what will be the profit? Profit is 20% of sales. That is 20% of 300. That is how much, sir? 60 rupees, isn't it? That is rupees 60. Now, what do you need to find out? You need to find out the return on investment. What is the return? Return is 60. What is the investment? Investment is 100 rupees. Investment is how much of the money you have invested in the total assets. And what is the return that you are generating? Return means what is the profit that you are generating by investing 100 rupees in the total assets, right? So if you want the return on investment, that is your profit of 60 divided by 100 multiplied by 100, that is 60%. Right? Is it 60%, sir? 60%. Right? So how they have calculated is, they say the return on investment is equal to profit ratio. What is the profit ratio? That is the profit divided by sales, right? Multiplied by the turnover ratio. That is the sales divided by assets. Right? The sales will get cancelled out. What is there is profit divided by assets into 100. That is what they have done here. Net profit ratio is 20%. Asset turnover ratio is 3 times. So return on investment is net profit ratio into asset turnover ratio. So this profit divided by sales is what? 20% that is given to you. Sales divided by asset is turnover ratio, that is 3 that is given to you. So this comes to 60%. Clear? This is how this was to be solved. I have taken, you can also solve it by taking this kind of an example. Assume the total assets to be 100, then calculate the sales, then calculate the return on that. This way also you can present it. No issues. After that, he says he has given the different scenarios that if the profit margin is increased by 5%, that is the profit margin is now 25%. Right? Asset turnover remains the same, that is 3. So what will be the return on investment? That is 25% into 3, 75%. Then if the asset turnover ratio is decreased to 2 times, the net profit ratio is 20%, asset turnover ratio is 2 times, then ROI comes to 40%. If the net profit ratio falls by 5%, that is 15%, and the asset turnover ratio raises to 4, then 15 into 4, 60%. Clear? So this was illustration number 2 for you. Let's quickly move on to illustration number 3. Right? Let's move on to illustration number 3. The following is the balance sheet of Messrs. Yamuna Enterprise for the year ending 31st of December 2015. Right, sir? The balance sheet is given. So a lot of things are given in the balance sheet. You can just go through once. Cash in hand, cash in bank, bills receivable, investment, debtor, stock, furniture, machinery, land and building, goodwill, preliminary expenses, then equity share capital 12%, preference share capital, debentures, public debts, bank overdraft, creditors, outstanding creditors, proposed dividend is there, reserves, provision for taxation, and profit and loss account. Clear? Then he says, during the year, the provision for taxation was 20,000, dividend was proposed at 10,000, profit carried forward from the last year was 15,000. You are required to calculate the short-term solvency ratios. What are the short-term solvency ratios? Current ratio, liquid ratio, right? And the long-term solvency ratios, that in the long term, how can we identify the solvency of the firm, right? Okay, so what they have done is, for the short-term solvency ratios, they have calculated the current ratio. Current ratio is current assets by current liabilities. Now, what all things they have taken in the current assets? Let's see. Cash in hand, yes sir, it is a current asset. Cash at bank, yes sir, current asset. Bills receivable, yes sir, current asset. Investments of 20,000. Now it depends. Investments are not current assets, sir. You invested for a long period of time, unless and until it is specifically mentioned that these are the short-term investments, right? Debtors, yes sir, current asset. Stock, yes sir, current asset. Any other current asset? No sir, right? So this is what is taken here. Now, what about the current liabilities, sir? Current liability is 40,000 plus 60,000. Bank overdraft is your current liability. Creditors is your current liability. Outstanding creditors is your current liability. Then after that, the provision for taxation and proposed dividend. Sir, this 10,000, if the dividend has been proposed, that means it will be paid in the immediate time. It is a current liability. If you are making a provision for taxation 20,000, that means you are going to pay the tax in the immediate year. It will be paid within a period of 1 year. So it is a current liability. So that is what is taken here. So this becomes your current liability. Correct, sir. After that, he says the ideal ratio is 2, but in the instant case, it is only 1.109. Hence, it is not satisfactory. As we all know that current ratio must be 2, that if you want to pay someone, that is if there is a current liability of 1 rupee, you must have 2 rupees in your pocket, right? As I have already explained in the conceptual lectures. Then the liquid ratio. What is the liquid assets? Current assets minus inventory will give you the liquid assets. Liquid liabilities are there. Liquid liabilities means what they have taken in the liquid liability is current liability, yes, minus overdraft. Yes, the overdraft will be subtracted here, right? This indicates that the company is okay. So this is about the liquid ratio. Liquid ratio is quite satisfactory because liquid ratio, we say it should be at least 1, right? Liquid ratio should be at least 1. So it is 1.155. It is comparatively satisfactory, sir. Right? Now, long-term solvency ratios is calculating the debt equity ratio, and he is calculating the EBITDA. EBIT is calculating. I don't know for what purpose he is calculating, sir. Okay, he's trying to calculate the interest coverage ratio, that whatever the interest is. See, first thing, this line should be here. This line should be here, right? What is the purpose of giving this line above EBIT? You are doing the calculation later on and writing the results first, sir. That is why I said not satisfactory. Now he says what is your EBIT? He says profit retained is 5,000. How this profit retention has been calculated? What is the profit that is carried forward from the last year? 15,000, right? And what is the profit that you are earning in this particular year? That is 20,000, right? That is 20,000. How this profit retention has been calculated? What is the profit carried forward from the last year? Plus, what is the profit that is earned in the current year? Total is 35,000. This is available. Now, out of this 35,000, you have proposed a dividend of 10,000 and a provision for taxation of 20,000, right? So minus 30,000. So what is the profit that you will retain? 5,000. Clear? This is how the profit retained has been calculated. That final profit that will be left. Add proposed dividend 10,000. We are basically doing the reverse working. So profit after taxes, add tax, PBT, add interest. Interest is on two things. Interest is on two things. These two things. 16% of 40,000 and 18% of 20,000. Correct. Right. So this is how the profit has been calculated, sir. 10,000. So you will get the EBIT. Now he says if you have to pay an interest of 10,000, you have a EBIT, that is the earnings before taxes, of 45,000. That means you have really sufficient earnings to pay off your interest liability, because this is an important factor. This is an important factor indicating your short-term as well as the long-term solvency, right? 4.5 times of the interest expense, which is quite satisfactory, sir. Right? It is normally seen in the long term, that in the long term, whether we will be able, because we are talking interest is on what? Interest is on the long-term debt. So we want to see that whether in the long term we will be able to meet our expectations, meet our interest liability, right? Commitment. Now basically, now the long-term solvency ratios is debt equity ratio. Again, it is wrongly calculated. Again, long-term funds cannot be there, sir. Cannot be there. It has to be equity only. It has to be equity only. So it will be 60,000. 60,000 is debentures plus debt, right? And what about the equity? It will be 1 lakh plus the reserves of 1,50,000. So it will be 3,50,000, sir. It will be 3,50,000, right? So 60,000 divided by 3,50,000. This will come to 0.171, right? So I don't know why the debt equity ratio has been calculated in this way. Even in the conceptual part, they have given it, but please don't calculate it. Don't do such financial mistakes. You are teaching wrong things to the students, right? Then they have shown the calculations only, how the long-term debt has been calculated. What is long-term funds? Long term funds, right? Okay, here while calculating the equity, you can subtract this preliminary expenses and goodwill, sir. You can. While calculating the equity, you have to subtract this goodwill 35 and this 45,000. It should be minus 45,000, right? 3,05,000. Right? So equity share capital, fine, sir. Preference share capital, fine, sir. Debentures, no ways. Okay, reserves, fine, sir. Yes, profit and loss account also to be taken, sir. That is correct. So still it is not correct. Okay, we will calculate it from there. I'm going to rub it out. Right? Profit and loss is also nothing but the reserves only, sir. Right? So this is not there, sir. Not done. Not done. So it should be 1 lakh plus 1 lakh plus reserves of 1,50,000 plus 20,000. It should be 3,70,000 minus goodwill and preliminary expenses. That is absolutely fine, sir. Right? Minus 45,000. I have already told that. So it should be 3,25,000. So here we have to take 3,25,000 as equity. So this should be divided by 3,25,000. That comes to 0.185. Clear? Shareholders fund 3,25,000. This is what they have calculated, right? So long-term debt to shareholders funds, they have calculated 0.1 time. Actually, this is the debt equity ratio, sir. This is debt equity. Both are quite satisfactory. It seems that the company has adopted a conservative policy for raising the finance. Under such policy, the equity shareholders may not avail the benefit of trading on equity that changes between the debt and equity. But yes, it is quite satisfactory that they have employed the sufficient amount of debt in comparison to the equity, right? If you have excess of debt, even that is not good, because then you have the fixed commitment of paying off the interest. But at the same time, if you have less of debt, then you are at the risk of losing all your own money, right? Then this is wrong, sir. Fixed asset ratio, they have calculated fixed asset ratio. Okay, that is fine. Okay, fixed asset ratio, they have calculated it, fine, sir. Fixed assets divided by the long-term funds, that out of the how much of the fixed assets have been derived from the funds, right? How much of the fixed assets have been financed from the total funds, fixed asset ratio. That's fine. The ratio is satisfactory. Then proprietary ratio, shareholders fund to total tangible assets. Total tangible assets. So this is basically what is the amount of proprietors fund. Proprietors fund means the shareholders fund or the equity part to the total tangible assets. That means how much of the total tangible assets have been financed by our own money, right? What is total tangible assets? Total assets minus this 45,000 is for goodwill, which is not a tangible asset, and preliminary expenses. Goodwill and preliminary expenses, right? Goodwill and preliminary expenses. So ratio is ideal and the long-term position is quite satisfactory. It is advised to improve the short-term solvency because the current ratio was not, up to the mark. That is why he says improve your short-term solvency, right, sir? So the time is almost up. We were able to do 3 illustrations only. It's okay, sir. No, not to worry at all, right? So we'll continue it in the next lecture from illustration number 4 onwards. Please think about the message that I have given at the very beginning of the video, right? And if you like it, do share with all your friends. See you guys in the next video. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.